Welcome to this episode of Crap No One Tells You. With me today is Rick Wagner from Raymond James Wealth Management, and he's going to tell us some of the crap no one tells you about being a financial advisor. So welcome.
Thanks, Gummy.
And we'll just dive right in. What is some crap no one tells you about being a financial advisor?
All right. So I thought it'd be more interesting if we talked about this from the perspective of crap no one tells you about investing or
Okay.
working with a financial advisor. Might be more interesting for your listeners.
I honestly think people have no clue what you guys do in general.
Okay. All right. So I'll talk about some of the things that maybe I'll end up talking about a lot of red flags and things people should watch out for, be careful of. But just to start, so what financial advisors do? A true financial advisor, and not all of them are true, real craftsmen, but a real craftsman in financial planning and portfolio management can add a lot of value to a client's life. How? So they could build a comprehensive written financial plan that shows that client how to retire early and with more money. They can help the client flesh out their estate planning desires so that when they go to an estate planning attorney to have the documents drawn out, they already have a nice crystallized view of what they want, how they want to protect their money and their legacy for their heirs. A true financial advisor can review a client's 401k at their work in an effort to reduce the costs, increase the returns, maybe also lower the risk, all with the goal of growing that money more quickly. They can help help retirees increase the amount of income they're receiving every month so they can pay the bills and make sure that they have a plan in place that drives income for the rest of their lives so that they don't run out of money. They can help you weed the junk out of a portfolio, the things that are slowing a portfolio down, or even better, weed the things out that are kind of the torpedoes that are going to sink the ship the next time a down cycle hits in the markets. There's so many things, pension decisions, Social Security decisions, those kinds of things are huge.
So let me ask you a question, because most of what you just said would kind of imply that you work with people as they're getting older. But that's not true at all, right?
So I can work with anybody of any age, and a true financial advisor can do that. It tends to be that people seek out the help of a financial advisor as they age. They don't have to be older, but the older they get, the more likely they are to do so.
Should someone younger be reaching out and start talking to you guys?
The earlier you start, the more likely you are to be on a better path. And there's no better investment superpower than time. So time is more powerful than any investing strategy or any great idea. If you have time and you apply discipline to that time, you can it's just basic compounding. You can compound your money at a rate that's so much better than if you started 20 years later.
Right. People often don't realize the power of compounding interest, for example, until they have a balance on their credit card. And then they see it rack the other way, right?
Inverse,
But it works exactly the same way. If you put that money into a market, for example, that compounding interest works exactly the same way, right?
Correct. So I have two sons in their 20s, and of course, with what I do for work, and one works with me now, and one's coming on board in a month. And but prior to them even working with me or about to work with me, I've tried to teach them about the power of compounding, because the more you know about that, the earlier, the easier your life is. And I've seen them digest that information and take action and invest in a way where hopefully they've set themselves up for a good future financially, just through the power of time.
Do you think enough young people are reaching out to financial advisors?
No, and I don't blame them. I wouldn't have done it easier either.
I know. I'm 22. I would much rather buy a 55-inch TV than put money aside, right?
But that's part of the discipline process. There are people who are overly disciplined and never enjoy themselves, people who don't have any discipline, enjoy themselves too much, and people have perfect balance. But when you're younger, it's also hard to envision bringing in a financial advisor. You say, what am I going to do with that? I don't have any money anyway, or the money I have isn't enough. And sometimes that's true too. But the older people get, the more zeros that are on the statement, the shorter amount of time they have until they need to spend the money, whether it be on college or on retirement or whatever it might be, the more serious it gets, and the more they say, you know what, I need help with this. It's like a surgeon operating on their own child. They look at it and they say, I know how to do that surgery, but I don't think I'm going to do it on my own child. I
Right.
think I'm going to have another professional do it. So they look at it and say, this is a lot of money. I think I should detach myself from the fear and greed emotional decisions attached with normally that go along with managing that much money.
So if you are younger, because you said, it depends on the number of zeros on your bank statement.
Yeah.
How many zeros should someone have before? Like, I know people that have 30 grand, 40 grand just sitting in the bank.
Yep.
And I always ask them, like, are you going to do something with this? Or are you just going to let it sit there and do next to nothing? Because bank interest rates aren't exactly phenomenal, right? Like,
yeah, but it's tough. It depends on the person. It's the question as to what should this, it's so hard to answer those questions because it depends on each individual person. For some people, that 30 or 40,000 bucks should sit in the bank because they're truly savers and not investors. They don't have the temperament to handle the movement that would come with a portfolio, even one that maybe that isn't even very aggressive. So, but other people might very much have that kind of temperament. They can handle movement over time in a portfolio while they seek higher returns. But each person's different. So there's no one-size-fits-all answer for what that person should do. It depends on that person themselves.
So when it comes to money, I always say, like, there's 4 types of people. There's the saver, there's the investor, there's the trader, and there's the spender. Right? The spender is the one that never has money because they spend all of it. The trader is the one that think they can play the game, so to speak. And I know very few successful traders per se, other than the ones that do it professionally. The category that I like is the investor category, right? Because that's the long-term thinking. That's the where am I going to be 20 years from now? Where do I want to be 30 years from now, right? Not thinking just about the now. And then you have what you said, like people that can't deal with the stress of any of the other things, then they become savers.
Yep. Right? And that's fine. And it's better for them to know that, to be aware of who you are and accept that and save or invest based on who you are. The strategy you can stick with is the best possible strategy.
Okay.
The one that you dive into and then sell low and buy high and repeat that process over and over, it's a quick way to end up penniless,
So if I was going to go look for a financial advisor tomorrow, what are some things I should be asking the financial advisor, or what are some things I should look at or like be cautious of?
Yep. So if you're looking at working with a financial advisor, the first thing I would do is look them up on Broker Check. So Broker Check, you can go to any internet search engine, type in Broker Check, and what comes up is a website run by FINRA, one of our regulatory bodies. And in there, you can type in the financial advisor's name, and up comes a report. And the report is going to show you lots and lots of things about that advisor. It's really comprehensive. It's going to show you what licenses they hold, what exams they've passed. It's going to show you their employment history, both in the industry and out. So you can look at it and say, this person's been in the business a long time, probably has a lot of experience. Or this person was not anywhere near this industry until 6 months ago, and I'm not sure if that's a good thing or not. I have to investigate further.
Right.
It's going to show you their educational background. It's going to show you their if they have any client complaints. Basically clients litigating against them for supposed wrongdoings, and it's going to show details of those. If the advisor has any regulatory disciplinary events where the regulators have come in and maybe suspended their license or something like that, and for what reasons. It's going to show you if the advisor has any bankruptcies. It's going to show you if there are any criminal events. It's really exhaustive.
Wait, whoa. So you could become a financial advisor with a criminal history?
You could. The thing is, so think of it this way. The Broker Check report is so comprehensive and exhaustive that you should be careful that you don't disqualify a financial advisor. There are a lot of great financial advisors out there who have a ding or two on their Broker Check. So for example, if you look up someone's Broker Check and 25 years ago while they were in college, they got into a bar fight, that's probably on there. Now, are you going to look at that and say, well, this person's not good at what they do and can't help me? Probably not.
Right.
It's probably not a disqualifier. But if you look on their Broker Check and it's like a rash on the computer with all kinds of things, you'll know it when you see it.
You should ask more questions at
You
least.
should, and you'll know it
Right.
when you see it. But it's a great tool to start the process of either opening a dialogue with that advisor about a specific issue, or maybe disqualifying them, or maybe saying, look, there's nothing on here except an educational history that looks great, licenses, exams, everything looks good,
So
But it's a tool so few people know about.
So when it comes to the actual advising portion, not all financial advisors are created equal, right? Like every advisor has an overarching financial firm they work for,
Yep.
but each advisor it's like with any other industry. Like you may be better at understanding someone's wants and needs versus a different advisor. But like, what makes that personal understanding relationship? What should you be looking for when it comes to that?
So that's a great question. So as a general rule of thumb, you should never let an advisor tell you how to invest your money until they've spent a great deal of time doing due diligence on you and what's important to you, what you actually need, which sometimes different than what's important to you, and that has to get fleshed out. They should spend a great deal of time learning about you first before they even talk to you about this is exactly how to invest your money. The best way to do that is for that advisor to build you a comprehensive written financial plan. If they've done that, an actual full financial plan, the due diligence process for building that plan is massive, and they will know everything about you that they need to know to give you the right recommendation for your portfolio. A financial plan will be the blueprint, the roadmap that enables you to invest your money better, more efficiently.
And that outlines everything, like your wants, your needs, how to try to balance all this stuff.
Exactly.
Like projected, what you're going to need for retirement, so on and so forth, based on what your retirement goals are, of course, and all that.
Yeah, and retirement is the single most popular goal for a financial plan, but it could be, hey, I want to stop working in pharmaceuticals by the time I'm 50 and I want to start a bakery. All right, we can build a financial plan for that. That's fine. Putting kids through college without student debt, student loans. Okay, we can build a plan for that. Maybe it's an estate plan, how to minimize estate taxes. And, while of course a tax planner is going to be the final arbiter on the tax side and an estate attorney is going to be the final arbiter on the legal side, we can build a financial plan that drives towards an efficient estate plan. So
it's a lot more than I think most people realize. Like not everything is about retirement. Like
No,
I
it's
said,
just-
like it could be, I want to start a business. I want to open a flower shop in 15 years and
Yep.
stop working corporate life.
And we can build a plan that drives towards that. Yep, pretty much any goal that you want to try to achieve, we can. A financial plan is simply, what are your hopes and dreams? Let me wrap some math and some formulas and some logic around that, and then show you what you need to do to get there. That's a financial plan. It looks for, financial plan tries to answer two main questions. Am I going to make it to whatever it is I'm trying to get to?
Right.
Retirement, open a bakery, whatever it is. And do I have any blind spots? So, and if you have blind spots, obviously work on those. So that's really what it drives toward. A financial plan is actually it's a very complex tool that really is very simple in what it tries to do.
Right.
But if you work with an advisor that builds you a financial plan as the jumping off point before they go ahead and tell you how to invest your portfolio, then they've done the due diligence necessary to make sure that their portfolio advice is sound.
Got it.
Yep.
So to switch gears a little bit, how did you end up as a financial advisor? Because you didn't, I'm assuming you didn't just jump straight out of college and went, oh, I'm going to be a financial advisor. Like,
Yeah, so when I was in college, I was fortunate enough to study abroad in London. I worked at Chemical Bank, which doesn't exist anymore, on the foreign currency trading floor, and decided I wanted to be a trader on the floors of the exchanges somewhere. And thought this is the greatest. I get paid to play a game all day. And
so when you say traders, that's the one we see in the old like Wolf of Wall Street movies where they're yelling at the floor, handing
Yeah.
paper, like that.
Sort of. I mean,
Okay.
Wolf of Wall Street is actually post that period. More
Okay.
like Trading Places with Eddie Murphy and Dan
Oh,
Aykroyd.
yeah.
So that movie was filmed in. Those scenes were filmed in the cotton pit in the New York Commodities Exchange. But anyway, but that I worked there for a few years. But But yeah, so I spent 10, 11 years as a trader in London, in Philadelphia, and New York, and on the trading floors in the loud yellow and green jackets, yelling and screaming, and doing the best I could. I had some great mentors that are still friends today, especially two guys named Dan and Bill, who I still love with all my heart, that taught me a lot. And it was a great profession, but very volatile profession. Some weeks you made more money than you could ever imagine, and other weeks you lost all of it or half of it. And as I got older and more mature and married and had kids and things got more serious, it's hard to live that rogue trader life hanging by a thread all the time,
Right.
even though it's really fun and electrifying. So this side of the business where you take the market's knowledge and apply that to helping clients was a real seamless, natural fit. My gap was on the financial planning side, so my knowledge gap. So I had to really build a better knowledge base in financial planning. So it's one of the reasons, like I'm a certified financial planner, which striving for that designation was something that was really important for me. It took me a lot of years to achieve it, just because
So it's not like you just read this online course and take a test and then they slap that certification on your name, right?
Well, there are a lot of certifications and designations in our industry that are that kind of thing, a weekend course, a small test, and you get some letters behind your name. There are a number of them, though, that are much more difficult than that. I could never list them all. CFA is one that's remarkably difficult. And the CFP is also very, very difficult as well. It takes a normal person like me, who's not a Harvard-educated genius, a number of years to work through all the classwork, all the exams for each of those classes, and then sit for the final exam, which is massive.
So that certification is like a school. Like it's multiple elements that then give you that designation.
Yeah, to me, it would equate to maybe a couple of years worth of undergraduate education in a year, full-time.
So it's like
years.
it's like a legit certificate.
Yeah. It's a massive body of knowledge, and I'm thrilled I have it, but attaining it was very difficult. But that was the area when I transitioned from being a floor trader, where you really in-depth understand portfolio management in the markets. I mean, it down to its very core, how to manage money in the markets, but you don't understand how to marry that so well with the financial planning side, which is helping someone strive towards retirement by managing their money properly. Those two things have to be combined together to make it really effective. So,
and I can tell you firsthand that trading is fun, but it's it's interesting, like the up weeks and the down weeks, and like I did trading for a couple of years on the side just for fun.
Yeah.
And then I had that epiphany moment where I was like, wait a minute. So my investment account actually made more money than my trading account did over the last year.
Yeah.
I'm like, maybe I should look at this investing stuff more and less of this trading stuff.
Yeah.
And that's kind of when, like you were talking about, you kind of graduate through different levels.
Yeah.
And I think once you get past that, willing to take a lot of risk for a lot of reward, or sometimes very little reward, you kind of graduate into okay, now I need to really start thinking about this.
Yep.
And I think that's the stage where people start seeking out people like you and go, okay, I need to be smarter with my money here.
Yeah, true. Some people will come to my practice from, picking up the pieces of their portfolio and trying to rebuild it. So people these days, it's tough because there's so many ways the so-called experts and strategists can get to you through your email inbox and the internet, and you see this marketing message come in and tell you, take these 3 simple steps and you can trade your way to retirement tomorrow.
Buy gold and silver.
Well, sometimes it's the buy gold and silver guys, and sometimes it's these 3 penny stocks are set to soar next week on some piece of legislation.
Yes.
Or sometimes it's, I saw this 2 weeks ago, buy these 10% a year tax lien certificates, whatever the hell that is. It's unbelievable. But avoiding those market experts is so important, but sometimes people haven't avoided them. They've hurt themselves, and then they come to me and say, I need somebody to do this who knows what they're doing. Please fix this. And it's tough. Those expert things, there's an old saying, why do they call them experts? And it's because the word charlatan is too difficult to spell.
Right.
And it's not just on the internet, it's on TV as well. Yeah. I mean, business TV, at least in this country, has become it's just morphed into junk food for your brain. That's
Oh,
all it is. And if you turn on business TV for any period of time, you see the same rotating group of talking heads telling you that this stock's a buy this week and this stock's a sell next week, and none of it's helpful. It's great
right.
marketing.
Oh yeah.
It's all it is so that they can sell more commercials, but it's not really there. It's entertainment.
Yeah.
If you walk into your financial advisor's office and on the wall you see a big TV and on there is business television and they're watching it intently and using it to make buy and sell decisions, you should get the same uneasy feeling you'd get if you walked into your doctor's office at Johns Hopkins and they're watching Grey's Anatomy or House for medical advice.
Right.
I mean, it's entertainment.
Yes.
Know that it's not actual applicable knowledge.
Like
so.
it's funny because I remember a few years ago someone was telling me about what's her name, Susie Orman and Kramer.
Yeah.
I forget what channel they're on, whatever. And I was like, so you're going to take financial advice from someone on TV that knows nothing about you or your situation,
Yeah.
that's really designed to be entertainment, but you're going to go by what these people are saying. And they're
Yeah.
like, well, yeah, they're on TV. They're credible. I'm like, yeah.
Yeah.
I'm not. We can debate credibility because you see all these characters, and because that's what they are. Most of these people on TV, regardless whether it's financial, whatever it is, it's an online person, or it's a TV persona, just like we have online personas. And yes,
Yep.
like, is it entertaining to watch Kramer with his like banging the bell and throwing the hammers
it's
and all this?
entertaining.
Yeah. Is there a tidbit of good advice there occasionally? Yeah.
Sure.
But if you don't understand the bigger picture, it's not really designed for the average person. It's designed for someone that has a base understanding of what's going on. It's just set up in an entertaining way, right?
That's right. Yeah, and it has to be entertaining. Otherwise, you're not going to tune in. People won't watch. I get it. You just have to understand what it is you're watching. So, and then people, the credibility thing, TV. So if you're an investor and you're watching TV and a commercial comes on and tells you that if you follow this system and do what we're saying, you can get, this is a very prevalent thing right now, you can get all the stock market's upside with none of the downside, right? And that's very enticing. If you could find that magic black box, right? If you could find it though, why would every dollar that's in traditional investing would flow into that while we're talking and never look back. So if it really existed, that would happen, and therefore, how could it possibly exist?
Right.
But that idea of all the market's upside, stock market's upside with none of the downside is heavily pitched on TV right now on major news networks.
I don't even know how that would function. Like,
sometimes it's too boring to tell you now. I can tell you how they purport to do it, but
it's not a reality. Like, that's the thing. Like,
not.
It's a well, we have this theory, but when down markets like what has just happened over the last 6 months, right? Like, the market has been hammered, especially if you're heavy in tech or any of that stuff. Like, there is no way that you can avoid any of this downside.
You can avoid it, but what you give up is all the upside. That's the way these things are pitched, is get all the upside. And they don't say it that way. Their lawyers have them say it very specifically so they don't get sued. But they're making you think they're saying get all the upside but none of the downside. So, it's a shame. I won't say the name, but the most popular one that's on TV all the time rhymes with Smash Proof. And it is frustrating to watch them market it in a way that is not as honest as I think it should be. Yeah, but a lot of people get drawn into that, and that's another kind of repair job we'll do with people's portfolios when they get drawn into that, and then we have to unwind that for them. There's an old story. It's funny, whenever I think of Smash Proof or its kin, there's an old story about Charlie Munger, who's Warren Buffett's business partner. And years ago, he was in Minnesota or Wisconsin, somewhere up there, in a fishing store, and he's looking at all the fishing lures on the display, all the big, beautiful display of orange and blue and yellow lures. And he says to the store owner, he says, hey, do the fish bite on these? And the store owner says, mister, I don't sell them to fish. And that's that get all the upside and none of the downside scheme, So it's a shame. But yeah, anyway, it's There are a lot of good people doing a lot of good work out there in this business, and then there's a handful of people you need to look out for and just be careful of.
So something you brought up early on that I want to kind of get back to is you said you help people structure their 401ks and stuff like that. Like, I still think there's people out there that don't realize if you job hopped, like even over 15 years, you spent 5 years at each work, you had a 401k at each workplace. You technically now have 3 different funds sitting in 3 different places, right?
Right.
And you guys can kind of help them merge though? Like, how does that work?
Yeah. So when you leave a company and you have a retirement plan like a 401k at that company, you've now had a triggering event which enables you to, if you'd like to, roll that 401k over to an IRA. Or you could move it to your new employer, to the new 401k if they offer one. When there are a myriad of other options. But what you're referring to is rolling it over to an IRA. So if you had 3, orphaned 401ks that you left behind at 3 previous jobs, you could roll them all into one IRA. Now, you don't want to do that without kind of looking a few times before you leap, and a financial advisor who knows what they're doing can counsel you on whether that makes sense for you or not.
Okay.
There might be some reasons why you definitely don't do that, or there might be some reasons why you do it. But it's not a black and white, oh, yes, every time you should do the rollover. It depends on each person's circumstance. I know that's frustrating to hear because it'd be easier just to get one-size-fits-all advice.
Right.
It just doesn't exist. But there are certain situations, lots of them, where the rollover doesn't make sense and lots where it does make sense.
Because not all 401ks are created equal either, right? Because a 401k is really just a massive investment account, right? Do I understand that correctly?
Yeah. Generally, a 401k is a really great tool when you're working at the company you're at. You can save money for your retirement in either a pre-tax or post-tax if they offer the Roth sleeve format. If they offer a match, that's a wonderful thing. The company puts some of its own money in exchange for you putting some of your money in. And some of them are constructed really well and have lower fees, and some of them are constructed poorly and have very high fees. That's why it's a case-by-case basis evaluating if you should leave that or not. And there are a myriad of other decisions as well. Maybe moving to an IRA doesn't make as much sense with regards to withdrawals. So sometimes it's easier to withdraw money from a 401k based on your age without a penalty than it is from an IRA. So you have to look at each person's situation.
But a 401k is more than just an investment account, right? Like, you could technically borrow money from your 401k, and like there's all kinds of things that a 401k does that I don't think people realize you can do, right?
That's correct.
And you shouldn't do it without a professional.
Well, that's correct. No, so there's another great example why if you have a 401k that offers the ability to take loans and you want to borrow against it, then you can go ahead and most likely borrow against your own money, take some money out temporarily and pay it back over time. If before you took that loan out, you rolled that 401k, over to an IRA does not allow borrowing privileges.
Okay.
So you've removed that functionality by doing the rollover. So loans from 401ks are not something I generally encourage.
Okay.
You probably should try to make that a last resort if you need cash flow. But if you roll it to an IRA, you have removed that ability.
If you want to buy a new Suburban, don't go borrow that money from
Probably
your
not.
401k, and you're better off taking the...
Probably.
Okay.
Yeah. Borrowing from a 401k can be dicey. If you've borrowed from a 401k and still have an outstanding loan and then you get fired or leave that company, you have a very small window of time to pay that large amount of money back before the whole amount that's left becomes taxable. So
now you're paying the taxes on top of whatever.
Exactly. So borrowing from a 401k is definitely something you do last. It's a nice little feature, but one you don't use unless you've exhausted all the other choices.
It's not like a lending account per se. Like,
no.
You shouldn't treat it as such.
No, that's
okay.
Yeah. Yep.
So I see you wrote notes too.
Yeah. Well, it keeps me on track in case there are things
So to kind of bring this full circle and wrap it up, if you were looking for a financial advisor today, first of all, at what point in your life should you start looking? And secondly, who should you start by talking to? Like, should you ask friends or family who they've used? Should you ask them for like what type of results? Did they take you through the like what are a couple of tips you would give someone as to now I want to go from being a risk taker or a spender to actually start thinking about investing?
So most of the new clients that come to my practice are introduced to our practice by existing clients. And I think if I was on the other side of the table, I would want a qualified recommendation from somebody in my family or friends or neighbors that I trust. Hey, go see this person at this company because they've done great work for me for 10, 15 years, and I trust them to do great work for you too. That would probably be the jumping off point. At what point would you do that? I mean, the sooner the better. And I'm not trying to drive clients towards financial advisors for revenue purposes. It's more the idea that there are a lot of people who will never need a financial advisor's help. People who are self-investors, who have great discipline, born with the blessing of great discipline. They're able to fight off their own fear and greed emotions through different market cycles. They somehow have digested financial planning knowledge and understand how to marry the financial planning process with the portfolio management process, and they can be the captain of their own ship. And that's an awesome, awesome thing. It's probably the same as the do-it-yourselfer who can do plumbing work and drywall work and all the other stuff that I can't do, so I have to hire somebody to help me do. But if you have those abilities, then you don't need our help, somebody in my industry's help. But for most people, or a lot of people, they probably do. It could really help you. Oftentimes, it's funny. I try to go out of my way to show clients whenever possible how what they've paid me, I've more than covered maybe with a certain piece of advice or a recommendation. So sometimes it's as simple as a Social Security recommendation. Here's when you should claim your Social Security compared to when you were intending to claim it. And here's the estimated dollar amount in benefit this advice is providing to you by doing it this way.
And people don't realize that like minor changes, changing it a year, changing it 2 years, when you're looking at the overall picture, it can have a drastic effect, right?
A huge effect. And it can also, when you're talking about Social Security or pension claiming decisions, if you're married, it can have a massive effect on your spouse because of what they can claim then, or if you were to pass away, which benefit they get versus the one they lose.
But ideally, you want to start planning that, what, 10 years, 15 years before it happens?
You probably want to understand how it works well before you're in your early to mid 60s.
Okay.
The earliest you can claim Social Security is 62. Latest is 70, but probably want to understand it in your 50s so you have a view as to what you're probably most likely going to do. Financial plan wraps that into it. So if you have a financial plan, it covers it.
So really the bottom line here is find someone that has, I'm guessing it's the CFP designation.
CFP is great. There are a lot of financial planners that don't have it that still do great work, but a CFP designation will the other thing the CFP designation does for the client is if they ask the CFP, hey, when you're working on my financial plan, are you working in my best interests?
Right.
As a fiduciary or for your best interest? And a CFP has to operate as a fiduciary in the client's best interest when working in financial planning.
So now I think we have the last question to wrap it up. So what's the difference between a fiduciary and a non-fiduciary advisor?
So a fiduciary advisor is required to act in the client's best interests. A non-fiduciary advisor, when operating as a non-fiduciary advisor, can work under what's called the suitability standard is the general term used. Is this suitable for this person, which is much more loose, a much more loose definition. The best interest standard is much more stringent and is the one that if you're a client, you would prefer that your advisor operate under. If I have no moral compass whatsoever, but I'm required legally to act in the client's best interests, it doesn't matter so much if I have no moral compass because I have to operate in the client's best interest.
Right.
If I have no moral compass and I get to operate on the suitability standard, the risk, it's not guaranteed, but the risk that I may do something that's still considered suitable but really isn't the best thing for you, I may advise you to do something of that nature.
So it's a much looser standard per se. Well, we shouldn't even say much, but there's definitely a clear definition of this one has a much higher standard.
Correct.
Both legally and morally than the non one does.
Correct. And a lot of advisors will operate on both standards. So
Okay.
certain types of work they'll do for people will be under the fiduciary and certain will be under the non-fiduciary. And that can still be a great advisor. They should just be communicating to the client which they're operating under when they're doing the work. In most cases, clients look at it and say, I know this person. I've worked with them for 10 years. If they're fortunate, they're able to say, this person's always done what's right for me.
Right.
I always know that they're looking out for my best interests. And so they tend not to get down into the weeds of, okay, at this moment, are we operating on this side or this side? It doesn't need to be said. But if you're vetting a new financial advisor, don't hesitate to ask them that kind of question.
Okay.
About, how do I know you're operating in my best interests? And
Right.
the advice you're giving me is in my best interests.
Okay.
So
That was awesome. Well, thank you so much for coming in.
Thanks,
and
man.
we might bring you back for some more questions about other things.
all right, I'd be honored.
So, and thank you everyone for tuning in.